All right, we are back with another Scale with Pros episode, and today we have Mr. Devon Kennard, previous NFL athlete turned entrepreneur, investor, private money lender, father, husband, amazing human overall. Excited to have you on, Devon.
Thanks for having me on, man. I got to tell the audience I've been like geeking out over the Scale with Pros podcast. I've listened to every single episode. I got like 15 more left, so I'll probably finish that in the next week or two. Because every time I'm working out or driving, I listen to a podcast, and if I find one I like, I go all in. So I feel like I already knew you, but I feel like I know you better just from listening to you for the last like month and a half nonstop.
I love it. I love it. Well, hey, appreciate the support, and now we get to have some fun, sharing with the listeners, with all of the experience, expertise, life lessons that you've went through in your business career too. So it's gonna be a lot of fun.
Yeah, absolutely.
So help everyone understand. Obviously, I did just a very brief, quick intro, but let everyone know your story. How did this journey begin into going into the NFL, this entrepreneurial journey that was, kind of at the same time, and then going into after. I'd love to have everyone understand that better of how this all came to be where you're at today.
Yeah, so I was a second generation NFL player. My dad played as well. So, growing up, I always wanted to play professional football. Like, I really like basketball, but I was looking at my family and I'm like, I'm growing this way, so wide and not tall. So maybe I need to stick to football. So, football was what I always wanted to do. But I got to college. I went to University of Southern Cal, and I started to face a lot of adversity. Coming out of high school, I was top recruit in the state, top 5 in the country, all of that. But I had coaching changes, injuries, to where it didn't look like the NFL was going to happen for me at all anymore. So I asked myself a pivotal question that I kind of want to pose on everybody in the audience. And it's like, did I want to be successful because of football, or did I want to be successful, period? So, that was a pivotal question that I started to ask myself in college. And I'm like, I have a vision for my life. And I always assumed I was going to achieve it through the game of football. But when it didn't look like that was going to be possible, I was like, well, hey, I still want that life. So I got to figure out how else I'm going to get it if it's not football. And that's where like my investing and business journey really started. I ended up getting my undergrad and master's degree while I was at USC. So I'm one of the few players that was drafted in the NFL and already had his master's degree. And I met a guy who was a mentor of me, and I sat in his office, and I came with like a suit and tie, really nervous for the meeting. He was a very successful guy, and he had like essentially what I'm wearing now, ironically, like a sweatsuit on, essentially like a sweatshirt. And it was the first time, this is like 2011 or 12, first time I saw one of those moving desks. And I'm like, this dude does whatever the heck he wants. Like, I'm in a suit and tie, sweating my butt off, like in the summer of LA. And this dude's like, just chilling in a sweatsuit. And he owned 8,000 units in LA. And he started his career off of a police officer's salary. And he was house hacking. So, a lot of the listeners probably know that. And he built his business up there. And that's where the light bulb went off. I'm like, if he was able to do it off of a police officer's salary and he built to what he has now, whether I make it to the NFL or not, maybe real estate is something I can do. So that segued into my NFL career, and I immediately started buying real estate as soon as I got in the NFL.
Wow. So immediately getting into the NFL. So talk about that path, because I think just for, listeners that, haven't had conversations with NFL players, going into the league and you choosing this path of investing and the path that, the headlines don't talk about. Most of the headlines are made 170 million, now bankrupt. And, it's like, that's what people hear. But so just curious for the listeners, I know offline we've talked about this, but, what's it actually like in the NFL of like what you kind of see of people actually, doing similar things that you're doing as far as investing in themselves, making, good investments and, actually doing, having that, thought process versus, just kind of not planning at all and not having any financial strategy. Like, what's that kind of like?
I think it's evolved a lot since, you
Hmm.
know, I was drafted in 2014, played from 2014 through 2023, so played 9 years, retired in 2023. And when I first got in the NFL, I feel like the locker room was still naive to business, to investing. There was always the anomaly, a few guys who were doing it, but the locker room as a whole, I felt like everybody was investing in the stock market and, you know, really tied to that and not doing really any much real estate, much business, private equity, really nothing along those lines. And that was a challenge for me. So when I first got in the NFL, I thought I wanted to do real estate, but I started asking vets in the locker room and everybody was like, stock market and financial advisor this and financial advisor that. So I dabbled in that at first. Like, I'm like, all right, this seems like it's what I'm supposed to do. And I quickly was like, this volatility, there's no cash flow. My big thing is, I told you about my college career. I got to the NFL, I was a fifth rounder. I'm like, I don't know how long I'm going to play. So I want to save as much money as possible so I can have like runway if I only play a year or two, what have you. And the stock market's volatility wasn't doing that. I wanted to get to like $10,000 a month in passive income. And, you know, 22 years old, $10,000 a month, that's buying a nice apartment.
Yeah.
You could, you know, have a lease on a pretty nice car. Like, I'm rolling, coming off of spending like $500 a month while I was in college. So that was my goal, and I pivoted from the stock market to buying single family properties, and I felt like the anomaly at the time because nobody else around me was really doing it. But you fast forward to the NFL today, and the player is way more sophisticated. Guys are investing in private equity, venture capital, real estate. What I'm seeing now is they don't know how to properly evaluate and underwrite these things. So, you know, you get some suit and tie dude who's paid a lot of money to a marketing firm to put together a great deck, and a guy wants to get into private equity or venture capital or franchising or real estate, and they're looking at this deck or the pro forma, the PPM, what have you, and they're getting enamored by the numbers. Oh, there's going to be a 30% return, and that
The
like
numbers look like they're going to go up. They're going
so.
up on the PowerPoint. They're going up.
So I think that's like the new challenge. Before it was
Yeah.
like everyone is going broke and they're not investing, and now I actually think guys are investing, but I've seen some deals that guys are doing and they don't understand how to underwrite yet, and that's a kind of something that I'm passionate about and how I always try to give back to guys.
Yeah. No, super, super cool. And appreciate you sharing that to give a picture of what it's, really like. And I think to that point too, it's, regardless of whether it's someone in the NFL, there's a lot of people that whether they make money in whatever respective field that they're in, a lot of people don't know how to underwrite or know how to look for the right type of deal or, vet out an operator because, to your point, especially with AI, it's like you can have a polished PowerPoint, you put on a nice suit and, you can speak well. It's like, seems legit, so it's like, how do you look into that? So I guess for you, let's just go into that for a second. Like if you're vetting out or you're trying to give advice to other athletes or other professionals that are, looking to invest in whether maybe it's a syndication, something in real estate or a business, what are the recommendations that you typically give to these guys or gals to, help them filter their decision?
Yeah, I mean, you got to kind of separate. You got to underwrite the operator and the actual opportunity. So because I found that a great operator can turn lemons into lemonade. Like it's not that great of a deal, but they know how to solve problems. They have a great team. They figure it out. They make it great. But a bad operator can take a great deal and turn it to shit. And so when you understand that, it's like, oh, they got this great deal, or at least looks great on paper, but what about the operator? So understanding what to look like in both. And I feel like, at least in the real estate syndication space, it's gotten difficult the last 10 years or so because there was so many people who were successful syndicating. Everyone was trying to become that syndicator because you could make so much money. You're making fees, the deal. And a lot of people were having success with it until the tide started to come back. And you're in the last year or two, and now, even now, and in the next year or two, because of interest rates and capital compression and all these things going on, you're starting to see that there's a lot of distress out there. And the people who didn't really know what they were doing, who weren't really good operators, they're going to lose the assets. Now, even the people who do know what they're doing, some of them are still struggling, but they're able to find solutions. They have the banking relationships and things like that to where they're making the deals work still.
Yeah, it's to that point, I mean, obviously both of us have been in the real estate world for a while. That's, it's probably like 3 years ago, I was seeing people get into some of these multifamily deals, and it's like, rates were amazing, a few years ago.
Hmm.
And now, to your point, it's scary because I hear about them, and, I talk to people, and they, we have conversations around, well, now their rates have doubled or more from that entry rate, and they're, now the property that they underwrote that was cash flowing is no longer cash flowing, and now the value's down, and now you got all this investor capital at risk. And it's scary, what's going on in the commercial space right now. But there'll be opportunity for, to your point,
Yeah.
like a lot of those good operators out there for sure.
Yeah, there'll definitely be opportunities, and being able to identify the good operators and understand the structuring of a good deal. Like I really like looking at fee structures, and do they have realistic projections, or are they kind of pie in the sky, optimism? So understanding, those things I think are pivotal, and I think it's important. Listening to your podcast, there's a lot of people who are building towards an exit, and they end up in a very similar position as athletes. And you got this chunk of money, and it's like, oh, I need to diversify it, or I want to dabble in this, dabble in that. And just because you ran a good business doesn't mean you now know how to underwrite a deal and pick a good operator. So I have, wealthy athlete friends as well as entrepreneurs who get into bad deals because they're like, oh, he's my friend and he's made some money on this deal, a good amount of time, so I'm just going to do it, and it's not a sound opportunity. So, even to that group of people, all the entrepreneurs out there who have exited are building towards an exit, just beware of that. You get this capital, and all of a sudden, everybody wants you to invest in their stuff, and make sure you understand how to underwrite the actual operator and the deal for sure.
Absolutely. And it's interesting. And maybe this is just not maybe, it is, because that just would be the case. But I've, over the years, anytime I've been, you know, uh, I guess convinced of investing in a deal that I didn't really understand, 100% of the time I've lost money in those deals. Like, it's literally not like, I try to think about it. I'm like, there actually isn't a case where someone got me to put money in like a deal, whether it's a real estate deal or an investment deal, or, freaking some crypto or something, that I didn't end up losing money. And then I made this decision. It was like, it's probably like 2 years ago now, where I was like, you know what? I'm not investing in anything that I don't fully understand. Like, because to your point, it's like people would show like, oh, well, this is what it's done. This is the history. This is what we expect it to do. And da 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 da. And I'm like, okay, I don't really fully get it, but I think I'm confident in this person. And I've definitely made those mistakes myself. And so I'm like, I'm gonna invest in my deals and then things that are very easy for me to understand.
Well, I think you said something key there, and I'm an avid reader. I listen to a lot of books and podcasts and stuff, and I've kind of been obsessing over like Warren Buffett and Charlie Munger, and they talk about your moat and building your strategic advantage, and really like putting your money towards things that you really understand and believe in. And as opposed to like Ray Dalio, who's obviously a very famous hedge fund guy, but he kind of believes in 15 uncorrelated bets, and he like through diversification. And people like it kind of, you got to kind of sit on which side, like, because Warren and Charlie are kind of like, I'm gonna pick a few businesses that I know really well, and I know the operators, I know the business. And the risk in that is if they're wrong, it could be a big loss because
Yeah.
you're putting more allocation towards a few small businesses. But the alternative to that is 15 uncorrelated bets, and a little surface level about a lot of things. So it's
Hmm.
almost like an inch deep, a mile wide.
Yeah.
And I've kind of, at my core, I feel like I was the inch deep, a mile wide person for a long time, because I was in the NFL, focused on that, and I built a real estate portfolio of single family properties up to 50 units. I started investing in a ton of different syndications and funds, mostly real estate, some private equity stuff. And looking back, it's like, to your point, I luckily had an advisor who helped me select good deals, but I couldn't tell you the details of half of that stuff. So
Yeah.
as I'm getting that capital back, I'm like, instead of going an inch deep, a mile wide, I'm going to go a mile deep and an inch wide and really narrow in on the few things that I have a strategic advantage in. I have my moat built, and I feel like that's kind of my formula, and the formula I've seen a lot of successful entrepreneurs have to build wealth. And then once you've built and amassed a crazy amount of wealth, then maybe that's when diversification and having all those uncorrelated bets can kind of come into play.
Yeah, no, that it makes a lot of sense, and it's interesting, which makes it even harder for people to decide, because it's like you have someone, a Ray Dalio, that's extremely successful, and then you have a Warren Buffett, Charlie Munger, also extremely successful, saying completely opposite
Completely
advice.
opposite things. But you also have to look at who they're investing for. So Ray Dalio is investing for purely like pension funds. And so it's like risk preservation in the sense of like, oh, like if the stock market goes to tank, we're also in oil or
Yeah.
yeah, like so you want all these different things, or we got crypto and we got this and that. When Warren, it's been, you know, private capital, you own shares. It's like the compounding. So let me buy a few really good businesses and make small, like fewer but bigger bets. And you know, both can be very successful. But I guess what you're building for with Warren, I love that compound component of like getting really good and really understanding a few businesses. And like, I don't know how much you've listened and stuff, but hearing you more, I feel like I would guess you fall more on the Warren Buffett and Charlie Munger bucket of you got scale with pros and you're selecting a few businesses that you believe in, and you might exit them eventually when you've grown them, but you're kind of like honed in on that. Like your
Yeah.
business is scale with pros, and you know how to underwrite businesses essentially. And you're going to pick a handful of businesses that you buy, scale up, and then exit potentially.
Yeah, yeah, 100%. I think I actually have, and you know, I think it's in, yeah, right here. I have the audio. I have the audio of it, but you know, for those looking, I have the Berkshire letters to shareholders.
Yep.
For those listening just to the audio, I was showing a book that's, you know, sitting behind me in the cabinet. That so I've been listening to the audio of that. So I'm definitely more in that camp. And you know, really with it's honestly like with Skill with Pros, it's been a little bit hard because there's sometimes people they're like, why don't you just go all in on one business and not have multiple businesses? And I sometimes question, and I'm like, man, like should I be doing that? But I also, you know, and I worked on this with one of my coaches, Jeff Mask. I actually just recorded an episode with him that'll be coming out soon too. But basically, you know, kind of like designing what I want my life to look like. And you know, Zig Ziglar is one of my, you know, favorite, you know, I guess virtual mentors. You know, he'd passed away before I ever went to any of his events, but you know, he had this quote where it's like, you know, if you can have everything that you want in life if you help enough other people get what they want. And kind of like what I see with, you know, what I do with Scale with Pros is, yeah, it's, you know, small consulting business that also is, you know, what will be my family office. You know, I haven't had a 9-figure exit. You know, I have, you know, I've been reasonably successful where I have some capital and I have some successful businesses, but I look at what I'm building with Scale with Pros to be what will be my family office, and the team that's at my leadership level is, you know, we're investing in deals, we're professionalizing them to grow, hold as long as we want, or, you know, have a definite exit plan. Like with the cleaning company, we have a definite target that we want to get to exit. You know, with some of the accounting firm acquisitions that I'm starting to do, I don't have a specific timeline that I want to exit, more so just some specific goals and getting it to specific points that if I wanted to, then, you know, I could go to exit at that point.
Yeah.
But, you know, being able to have that be the allocator of capital into deals, the team that helps me work on the deals and, you know, mentor the founders in those companies, because I get a lot of joy from that. And having, you know, a lot of my work is more of like I'm doing one-on-ones with my partners in those companies that I invested in and coaching, guiding, leading, helping them with the strategy to, you know, go to the next level. And then my team actually helps execute the actual work
And
within them.
I think people who say that to you and just focus on one business, they are missing it though. And I only catching it because I listen to a lot of Warren Buffett and Berkshire and all that, but then also listening to Alex Hermosi, which your model is kind of similar to both of them, in my opinion, at least, in that you have your holding company, Scale with Pros.
Yeah.
Your business is helping build other businesses. So it's like
Yeah.
it seems like you're in a bunch of businesses, but your business is doing that. So it's kind of like different. Like Scale with Pros is consulting and buying and building your own portfolio of businesses and helping other businesses. So like it looks like you're dabbling in so many businesses, but your business is that. Like it is
Yeah.
actually helping grow companies essentially. So when you understand that, it's like well, it makes sense that you have several companies. Now, if you were to have that company and then also had a real estate syndication that you're doing on the side, I feel like that is misaligned
Yeah.
because that's completely different. But when you are underwriting and selecting businesses you buy for yourself and getting hired to consult with other companies, I feel like that all is under that same Scale with Pros umbrella. But I've had to kind of realize that even within my own business because I have a holding company and that's Kennard Capital, but my main operating business is 42 Solutions, which is my lending company, and my kind of like goal right now, I'm just focusing on 42 Solutions because I want that to grow, but eventually I'll probably own other businesses as well. But I'm like, as far as a capital allocator, I can allocate the best risk adjusted return within my lending company as I look at any other opportunity I have in front of me. So I'm going to focus on that, max that out. And then when I'm having an overflow of cash flow, an overflow of opportunities, then I can, add on from there. So I think that's kind of a change in perspective that I've had to realize when looking at companies like yours or even my own.
Yeah, no, and it makes total sense, and I think at the end of the day, it's just designing your life and your business the way that you want to live as well. Like I would honestly be bored if I was only working on one thing. I don't have and that could just be another flaw. I don't know, we'll find out in 40 years from now, but I get bored if I'm just working on one thing, and not to be confused with I don't want to do boring work, because I'm all in on doing the boring work required to, get the results that are, the outcomes that we want to get. But, it's that some of that variety of being able to work on different deals and learn, and the learnings across them too. It's like we learn one thing in a business, and then it's like, that's the new way we're going to do this. Let's roll it out across all of them. And then we're able to get, a good return on that. So, so for you, Devon, what's the goal for you now? So you have your lending company, which I always see you posting about, and the deals that you're doing. What's kind of next? Continuing to scale that up, or is it, because I know you've talked about a few different ideas on that.
Yeah, so man, the last 2 years, it's been 2 full years I've been running it, and I built my loan book to up to 10 million already. So that's exceptional for me. I've had almost 200% growth in 2025 compared to 2024. So I just want to continue to grow, and I'm doing that kind of. The next phase in my bottleneck right now is capital. So, I've grown a lot over the last 2 years. So now I'm actually freeing up a lot of my own capital. So I'm looking at the return on equity in my real estate portfolio. And I'm like, by the end of the year, I'm going to have 30 of the 50 properties I had sold, and I'm going to be down to 20 because when I look at the equity that's grown, the opportunity going forward in my real estate portfolio, it doesn't really compare to what I'm doing inside of my lending business. And so, I'm selling those assets. Some of them I'm going to have to take the capital gains hit, but I crunch the numbers with my accountant and all that. And it's like, I'm going to make out better if I take the capital gains hit and bring that money into my lending company. So that's one way. And then I'm going to start bringing in outside capital. But my book of business now has been pretty much 90% my own capital. So I feel like I've built the track record now,
Yeah.
and the next phase for me is start to raise investor capital and partnerships to be able to lend out more capital. But I want it all private. So in my business, a lot of people, they kind of they start to get institutional capital behind them, so they can chase volume. So
Yeah.
for me, what I found is I rather run a really lean operation and work with private investors who want to work with me, my book of business isn't going to be as large. I'm not going to say in the next year I did 100 million loans, but my net profit margins are going to be way better because, when when they fund $100 million in loans, but they only got, the origination fee, and they got to split that with loan officers and, and
Yeah.
things like that. So, I just decided my business model is going to be private. I'm going to have a small team, and with a small team and the right software, I can do a great amount of volume and
Hmm.
keep the margins really high.
I love that. I mean, I think, lean and mean, for a business like that. And, I've been doing private money lending the last, couple of years. And, I think it's one of the best businesses, obviously, once you have the capital to do it. And then, or if you could, raise capital in that type of structure, it's funny that you're talking about that with your real estate. I'm actively right now working on selling more of my real estate. I didn't quite have as many like single family properties. We have just under 30 left right now. And I'm trying to, as leases are coming up, I'm just selling. And similarly, just, I was trying to like sell a package of them so then I could 1031 and into like maybe a luxury Airbnb. But I'm like, even I was underwriting the numbers with, my friends that do luxury Airbnb, and I'm like, man, like the returns are terrible. It's like, yeah, it
It's
would be
not
a
it's
nice.
not that great. And then you
No,
have issues, and then you got to like renovate it, because if you want to do Airbnb, it needs, and it's just like,
yeah,
I think people get caught up in like the tax benefits and the
yes,
long-term
it's
appreciation of
overstated.
it.
People think that
Yeah.
tax. It's just like I regret transparently a few properties I've bought over the years because it was like close to the end of the year. Looking at the tax bill, I'm like, well, it's marginal deal. And if you bought marginal deals in the last few years, now they're bad deals because rents have softened and
Yep.
repair costs have went up, insurance has went up, taxes have went up. So those are ones that I want to sell now.
Yeah, I would say like I I'm almost like a recovering real estate investor and just an entrepreneur now, because when I like, the numbers don't lie. I feel like I'm a data person, and
Yeah.
when I crunch the numbers, I'm just like, the return on your investment is not as good unless you're inside of real estate running it as a business. Now, if you are running a flipping company, or you got a wholesaling gig and you're buying some of your own properties, so you're getting them for dirt cheap,
Yeah.
then your profit margin. But like, that's never what I really wanted to be or do. So unless you're like, you're running it as a business, then it's a business though. It's not just real estate. You have a whole, like, you're bringing in, you got cold callers to bring in the
Yep.
deals so you can purchase. So now you're just operating a business. But if you're just buying real estate to hold and you're not running it as a business, the return is not very good.
No, it's
So
really
when
not.
people realize that, I'm like, all right, so for me, I'm like, I'm going to bring more money into my business, into my lending, and then down the line, if I want trophy assets or I want some commercial properties, I can consider at that point. But I can make way higher return just biting the bullet and paying some taxes, writing off everything that I can within the business, and just, it is what it is.
Yeah. No, I mean, that literally, that's been my realization over the last, I don't know, year, 2 years. And I'm like, man, I want to sell these properties. I'll probably get down to where I have like my favorite 5 to 10 that cash flow good, have the least amount of headaches, that have been consistent, that don't have any big capital expenditures coming up in the next couple of years, and selling down to those and eating the taxes, being okay with it, and then putting that money into, lend. Basically, what I do is I'll put any of my money just into lending until I find like businesses to buy. And then, like, once I find the business and as funds come back, I'll use that to put into the businesses. But that's, again, like looking at the same thing on the returns, I'm like, that just seems like a better plan to execute on. And honestly, I've been getting beat up by repairs this last like year and a half. I feel like every one of my properties has been having issues. So it's like, my assistant will be like, "Oh, we have to put 15 grand into the rental entity." And I was like, "Why?" And she's like, "This one had a pool repair. This one had a roof leak. The rains that happened like a month ago that were severe. One of our tri-level rentals, the bottom floor flooded. So we had to get, that cleared up." And it's just like, what?
Always something.
Yeah. But they cash flow, so it's
Yeah, I mean, and they could cash flow well. I bought a lot of stuff in the Midwest early in my career while I was playing, and they
Hmm.
cash flowed amazing. But now CapEx is starting
Yeah.
to eat past years' returns
Yep.
because like even there were cheaper properties and they cash flowed great, but when they do start to have a lot of issues, it's eating chunks of that cash flow that you're making. So
Yeah.
I love real estate long term, but
Yeah.
I don't think unless you're operating it as a business, I think it's overstated in a lot of ways. When you start to understand what business can do and you start to look at return on equity, return on assets, CAC and LTV of businesses, and you start to look at these metrics and you're like, yeah, this is a lot better. And then as far as, in real estate, it's appreciation. Well, you can control appreciation in your business by EBITDA
Yep.
and gross and net profit margins. So, if you can systemize your business, which is something I'm in the process of with 42 Solutions now your business is worth a multiple, and
Hmm.
that's relative to your appreciation in real estate. So, when I understanding that's been a huge help for me for sure.
Absolutely. And to the, to those listening in real estate, it's still a good business to do, wholesale fix and flip. Like that's where my background was for years. I did that for years and, it's good. It's just, for me, it's like, I just love the business side of business more than I did love real estate. And then, again, the returns, in business could be significantly higher and in shorter periods of time. To your point on like the EBITDA, it's like you could buy a business that has reasonable profitability for a fair price. And that's also the interesting thing. And I've learned this, Devon, was like the first deal, like bigger business deal, which is still small in comparison to like the world, like the plant guy business that I invested into is a few million a year company. And it was a fixer upper, and I would never buy a fixer upper business. So like anyone that ever wants to buy a business, never ever 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 buy a fixer upper business. I thought from coming from real estate, you buy fixer uppers because that's where you can create value by fixing the property up and forcing appreciation. Instead, what and the business is good now, but it's like 2 years, over 2 years of my life had to go into helping fix that business to get it healthier and getting a lot of the things in place. And really the value creation wasn't from that. It was now from the, increase of the EBITDA of the business. And so it's like, I would much rather just buy a business that like
Has
this.
good fundamentals already.
Yes, yes. Like this accounting and tax deal that I just bought. It's not a bad business, not a fixer up or just no technology. Like they were generating good revenue, almost $1 million a year revenue, a few 100,000 EBITDA, but no technology. Websites from freaking 100 years ago, there no CRM, no systems, tools, softwares, like very antiquated. And so, it's already making money with despite themselves. Like that's what I want to buy. I'm like, there somehow a business is making money with a not ideal process. Like that's the business you want to buy instead of the fixer upper.
Yeah, absolutely.
So, but yeah, so that's, there's been a lot of learnings on that. So, for you, I guess on the lending side. So were you, going to put together kind of like a fund to put money into from private investors, or how are you going to kind of put that together to start bringing partners in?
Yeah, so I think eventually I'll do a fund, but
Mm-hmm.
right now I've been able to raise almost $2 million already, based
Mm-hmm.
solely on promissory notes to the business, essentially. So
Mm.
like outside investors are lending money to the business. I still had to register with SEC and get like Blue Sky and all that, but it's a much less daunting thing than starting
Process.
like a fund. Now the
Mm-hmm.
the downside is, like, all right, I gotta like have the conversation with the investor, like you're lending to the business. So my conversation with them is like, you're lending to 42 Solutions, my business, but 42 Solutions owns this book of loans, and I show them my whole book of loans, and like, so the collateral and the assets are controlled and owned in the loans by what I own with promissory notes from all my borrowers. I only lend up to 70% of the ARV, all of these things. So I have that conversation, and I think I can reasonably get to 5 million. And, as I keep growing the track record, maybe even 10 million raising that way. I think if
Mhm.
I want to go far beyond that, I may need a true fund structure. But I found this, maybe other people couldn't raise that way because it could be a harder sell. But I think my position is strategic when I'm the biggest investor in the business. Like I'm
Yeah,
putting a lot of
absolutely.
my own money into it. Like you're just investing alongside of me and essentially lending my company money so I can go lend out more. And I make the small spread and you're make your interest on it. So that's kind of how I structured it. And I think until it starts to break. I'm
Yeah.
kind of like build the plane as it's going and working with attorneys, making sure I'm compliant and all
Yep.
those things. But until that becomes a challenge to raise that way, I feel like I'm going to continue that. But my number one lever is getting more of my own money. So as I have a lot of money in syndication still and still own a good amount of real estate. So I want to free up as much of my own capital as I can because I really want the cash flow to just be so robust in the business that I'm reinvesting a lot of it outside of the salary I want to take and then in 5 or 10 years having age at my advantage, that it's going to compound and be able to really grow into a pretty large company.
Yeah, I love that. And so what's the team look like now? I know, it's like keeping it lean and mean. So what do you have on your team today?
Yeah, so I built out a whole org chart of what I wanted to be in the end. But right now I have myself, which is like founder, CEO. I feel weird saying CEO when it's a small lean company, but it feels kind of like, but
Yeah.
whatever, that role. And then I have my executive assistant who's full time. I have my bookkeeper who I'm actually bringing on. She wants to take on more. So she's not going to bookkeep for anybody else and is going to take on
Nice.
servicing within my company. So I mean they go hand in hand already. So where you're already bookkeeping, can you handle draw request and stuff
Mhm.
within my loan software? So she's taking on that, but that's two different positions. But we're going to try it out with her doing both. And then I have a marketing manager, and that's my team. I think so. We'll see how that goes with my bookkeeper taking on servicing.
Yeah.
If it goes great, then she can do both roles. If not, I'll probably bring in a servicing manager, and then I'll have eventually a processing manager or like a transaction coordinator who's like,
Mhm.
I'm leveraging software and my EA to handle it now because it's
Yeah.
not, with my size, I funded
Yeah.
about 25 loans. That's manageable with
Oh
my
yeah.
with this team. But as I grow, when that's 50, 100, having someone really compile everything and then I sign off. So I want everything together, make sure it
Yeah.
checks, know what to look for, everything to where I'm getting like the final buttoned up package and I get to just like scan through. I like this. Okay, I already have the valuation report in place, all the things we like to collect, and I could be like, okay, we're good to go. So I think that's kind of the play. I'm really big on SOPs. So one thing my team probably hate it, but I make them do write out the SOPs for everything. And you kind of put me on to Loom last year, I think it
Yeah.
was. So I've been using Loom videos. That's how I'm training everyone up. But I think I can probably get to at least 25 million with maybe one or two other people on my team, and like that's going to be really impactful. And over time I'll probably add like a COO to kind of oversee everything because I want to remove myself, and that'll increase the value, the multiple I can sell it for, because
Yeah.
I'm still in it, the
Yeah.
business, a lot right now. But I want my hands on everything. So I feel like that's the phase I am in my business. But I want to be able to just kind of make pivotal decisions within it and then
Hmm.
be the marketing funnel for a
Yeah.
lot of it. But with being a smaller capital allocator in the lending space, I'm growing my email list now to where I'm hoping once my email list is like 2,000 potential borrowers, even when I get to my loan book at 50 million, I'm going to be able to get that out within my own email list to where I'm not having to fish for a lot of new business, and my CAC is extremely high. Cost to acquire a customer are extremely low
Yeah.
because I'm, it's really just word of mouth and me going to an event, meeting a couple investors, bringing them into my CRM and my email system. So I really leverage my small team, the loan software system I have, and I use Active Campaign as my
Mhm.
CRM. And I feel like I'm going to be able to like rock and roll and really grow with that team, plus or minus like 2 people over time.
Oh yeah. No, I super helpful to understand what it looks like now. And honestly, like on the TC side, like you'll be able to I mean, in our real estate business, the most we kind of got up to is like doing around 10 to 12 deals a month. And that would be like between like, some wholesaled, some would close to be flipping, some would close to buy as rentals. And we had one TC that was able to handle all of that pretty easily. So they were handling over 100 deals a year. And so, I think, with the current team you have. So like right now, I had my executive assistant, get her notary license. So like, to help me with like not having to screw around with other notaries and like running around.
That would be huge for me. I mean, there's a notary not far from my house, but I'm having to do that constantly.
So if you could is your bookkeeper local?
No, they're not. My bookkeeper is in the States, but she's in Utah actually. And then my EA is virtual. So it's like, I kind of need I want maybe one person on my team to be in state, cause that would be nice. But honestly, being able to hire like virtually is like a game changer.
Easier to hire that way. 100%.
I mean, they're really 1099 just contractors. And then, like I don't have any actual employees. All my people I work with now are 1099s. My bookkeeper and who's going to be taking on servicing, I think as the business grows, she might have to become an actual employee. But right now I'm operating on 1099s because they technically have other clients still, or they're overseas and you can't bring them in as an employee anyways. So
yeah, no, that makes sense. So I'm curious, do you on any of your loans, do you charge like a transaction fee or anything outside of like the points or anything like that?
So I charge, my standard loan is 12% with 1 point, a $9.95 processing fee, and a $500 doc prep fee. Okay. But the doc prep fee, I've been able to completely internalize. I had my attorney draw up the template. So if it's ever a loan that's out of the box, I'll go back to my attorney. But if it's my standard stuff, we have the software that it pulls all the information within my loan software system into the loan docs. So, I'm charging $500, but I don't pay anything anymore for that. Yeah. So that's a profit center now. And then the processing fee, I guess that's my fee because I'm still kind of overseeing it. But with my EA, we're using the loan software. They're downloading the documents within the software. So it's pretty efficient. And my wife is an agent, so she kind of does all the comping and, so all my valuations. So I'm able to kind of do that internally, and I approve the loan, and we kind of get it rocking and rolling. So I'm able to produce a loan package like for my repeat people. That's why I'm able to get so much business. I'm like, oh, you have a deal? Well, I have the capital. We can fund 2 days, a day, whatever. So that's been really helpful, being able to leverage like AI and the software system, and then like executive assistant has been huge.
Yeah, no, I love that, having the doc fee and then the processing fee. Because I was going to say, one of the things that, like I had my executive assistant here, I pay her a salary, but I had her start, basically transaction coordinating. And basically she does everything on my loan. So like when a loan request comes in, she looks it over, and, if it's one that, I'll comp real quick to approve. I'm only, give or take 15 to 20 a year, depending on how fast or long some of the deals take to go. But basically, on those, I'll have her take all of the, the documents, prep those, put those together, and then, coordinate with the title company, send the wire, and do everything on it. And then basically like the processing fee is like, I give her an extra like kicker on each of those deals. So it's like she gets, the process, that processing fee, which she's excited about because it's an extra, whatever, couple $100. I think ours is a lot lower than where yours is at. Maybe I need to raise prices. But I charge 14%. So we're like 1 point up front, 14% interest paid monthly. And that's for 6-month term. And if they have to extend, then it's another point to extend for another 6 months. So that's kind of what I have it set up as right now.
No, that's a great model. Like being able to charge the 14%. So you essentially in 6 months make 7, and then you're charging the point. So that's 8% in 6 months times 2. You're making 16% plus, and that goes into, there's not many, at least in the real estate space, many investments that's giving you a 16 to 20%. annualized return.
Yeah, we got to pay taxes on it, which is, it is what
It
it
is what it
is. But
is. Yeah.
but it's yeah, that's where I have a hard time wanting to keep money in the other real estate because it's like, yes, I get depreciation, it helps reduce taxes, but again, it's like repairs are up and all those other things, so it's like the real return is a lot lower than what I could
Yeah.
be getting just lending, and
Just
I
lending and
have
paying the
been.
taxes, and then you could write off the taxes or some of your expenses through that to decrease the tax, or your tax hit. So it's like,
Yeah,
it
yeah.
works out.
So it's I'm not planning to. I mean, I guess it's just like as I have capital, like that's where I choose to allocate it. But I just have a handful of investors that I've known for years that I just lend to, and it's just like same over and over
I'm
again.
actually glad to hear you say that though, because I feel like more people with capital should do this. Like, instead
I
of
don't know why
investing
they
in a lot of,
don't.
like, I try to teach pro athletes or like anybody who like has a good high net worth individual and you got some capital on the side, like you're looking at all these opportunities, and I'll put it out against almost anything. What's going to give you a better risk adjusted return on your money
Yeah,
than
and you have it secured against an asset. It's like it's not secured against a business, or something else that's not tangible. It's like you have it secured against a property that's, I'm like, I look at some of these deals that some of my buddies get, and I'm like, man, like if you defaulted, it would be a win for me because this thing you got it like freaking 40% of what it's worth,
Exactly. Exactly. So, and that feels good knowing the collateral is there. I think an advantage you and I have though is we understand real estate and we've been investing. So, if they're just a business person, then lending might seem like so
Scary.
scary. Yeah. But
Yeah.
because we've been on the other side of a lot of those transactions, we're like, yeah, let me be the bank. I got a little money here.
Yeah, not deal with all the stuff on the flip, So I have a buddy that he'll buy, he'll find lots around town here, and he has a mobile home dealership, and so I've started JVing, and we're actually finishing up one of the first JV deals with him where he found the lot, cleared it, put a new mobile on it, and so I funded everything, and we're doing it as like a 50-50 profit split deal. And man, I would have made the same amount of money just lending on it than I would have than I'm going to on JVing the flip. So I'm like, man, I'm just gonna go, and I set it up as like no payments to me until
Oh,
the
the
back
back
end,
end. Yeah.
because we'll
See,
just get the back end profit. I'm like, man, I'm not gonna do that anymore unless it's like a stupid deal. But
yeah. Well,
but
I think that's why I love like having my own private lending company now, because we're really when you really break it down, we're talking about the capital stack, which is in business and everything. And I'm just a lender, but I have the documents in place to where like, oh, if it's a riskier deal, I can be like, oh, I still want my interest, but I want an exit fee. So I'm taking a piece of the profit on the back end. So, I've done some of those where like, all right, I'm still going to charge 12%, but you want a little higher loan to value than I'm actually comfortable with. I want to be compensated for that. I want 10 points on the back end, 5 points on the back end, whatever we're negotiating. And that's a huge profit center. You have JV opportunities. You can take equity. So it's kind of cool. Like, and I don't know if assuming a lot of your listeners know, when they're talking about like investing in businesses, you have your first position lender, second position lender, mezzanine debt, which is kind of like second position, your preferred equity, and your common equity. And knowing where you stand, whether you're partnering on a deal, whether you're lending on a deal, where you stand, there's a return level that you should expect at each level, because it comes with a different risk risk level. So understanding that, and the more I understand that, and being able to manipulate that capital stack to juice returns at times with good operators, is something I'm kind of leaning into in 2026 as well. Like some of the people who they're trying to go from 5 flips to 10, it's like, all right, that's going to cost you a little bit because you're spreading out, but I've seen your track record, see what you're doing. We can try on a couple, see how this goes. But now I can push my annualized return from mid-teens to like lower 20s on capital, just by knowing how to manipulate that capital stack based on how I'm bringing in the capital.
Yeah, no, I love that. So, finding ways to JV and bring up the returns on the back end. It's so good. So when we talk about, within Skill with Pros, everything that we do is trying to help people, shorten their learning curve to getting more successful faster is really the goal. So, as we come close to the end here, I wanted to ask you, like, if you can think of a lesson that's helped you get to now where you are that you wish you would have maybe done differently that would have helped you go a little bit faster in business, like
Yeah.
what kind of comes to mind that you'd like to share?
Um, I would say get really good at something first. Like so many people kind of spread themselves thin trying to do so much. And if you master one thing, it's easier to go slow to master one thing and then you speed up way faster later. Like as opposed to like dibbling and dabbling. I'm gonna invest a lot of money in crypto. I'm gonna try to start my own business. I'm gonna do this. I'm gonna write a book. I'm gonna have a podcast. I'm gonna like it's like, bro, master one thing and then you can add on the next thing that makes sense. I think that shiny object syndrome affects a lot of entrepreneurs and people that if you just lock in for a while and really master it, then you can speed up faster later. So the idea of delayed gratification, I think, is huge. I didn't do it wrong, but one thing I feel like I've done right is like networking is really, really powerful. But like with books and podcasts, you can learn so much. Like I do go to masterminds, I do go to conferences and all of those things, but like I consume so much content as far as it relevant to my business. Every lending like book out there I've read. Every podcast that's on the subject I've read. Now I'm on to like business generally. So I listen to Scale with Pros, and then how can I take what you guys are talking about and like bring it into my ecosystem, the way my brain works, what fits my business. So I don't think enough people are like doing that because you can gain so much. Like there's nuggets. For instance, I was going to ask you, and then I heard a podcast on like, if I keep hiring VAs, do I have to bring them on as salary? Like that's like a conversation I would have had to learn at a conference one day, or like, luckily I know you as a friend, so I could call you, but just listening to a podcast, dropping my kids off, I'm like, oh, they're 1099s. That doesn't really happen. Like you could keep them. So it's like, there's nuggets you pick up and like learning them, but then applying them is really impactful. I don't think enough people apply what they're learning. And I feel like I've been able to like master that. Like you taught me about Loom video and I took it and ran with it. And I have literally 1,000 videos of Loom video. But like, that's just an example. Like we had like was that a year ago, one short combo and you told me about it. And I like went and ran with it. So I encourage everyone out there to like, there's so much you can learn for free nowadays with YouTube, with podcasts, with books. So like the people that you look up to, people who are doing stuff, learn as much as you can, but like take the next step. And I call it like shoot your shot. So many people learn and don't shoot their shot. For me, I feel like I've been able to master, like I'm going to learn and apply. And it might not be perfect, but I'm going to keep on applying. And like I mentioned the plane, like putting it together as I'm going, and you'll be amazed. All of a sudden it's like flying on its own, you know?
Yeah, absolutely. So there's a lot there. So in the first part of that, talking about shiny object syndrome, and so somebody listening could be like, well, Devon, you're in multiple different types of deals, or back to the thing of like, Cody, you're in multiple types of deals. I think it's a, focus, follow one course until successful. And then once you've done that, you can diversify a bit, and you can do that. But, to your point on the shiny object syndrome, every opportunity is hard. Every business I'm involved in is hard. They all have their different problems. They have their different, areas that are easier and then areas that are harder. And that's, like with the cleaning company, very easy to market and sell. Very hard to, we're doing right now almost 100, we're cleaning almost 100 houses a day during like this holiday season between all of it. So it's like hard to make sure quality control is good on all of that, right? So that's that, and then you look at another business, like let's just like the accounting firm, marketing and sales, a little bit more challenging to find like the right niches, but also recruiting is really hard to get really good talent that can do the work that you need done at a high level. And so like every business has good stuff and bad stuff. And so, it's just picking the thing and then sticking to it. It's just, there's, to your point there, just you have to do, put your head down and just grind. And there was a book I read from Darren Hardy. I think it was either in Compound Effect that he wrote or The Entrepreneurial Roller Coaster, is one of those two. But he talked about, whatever business you're going to do, commit 4 years and don't pick your head up until you've spent 4 years doing it, because then your commitment to those 4 years of doing that business will actually allow you to get the results that you're hoping for,
I love
instead of
that.
thinking it's going to happen in 6 months. And so that's kind of like always been my thought process, is like, even with Scale with Pros, I'm like, I'm going to start the consulting thing and have a 4 year commitment to doing this thing, whether I'm having fun, not having fun, I'm committing to the process. And I think, that a lot of people, they see stuff on Instagram or see other businesses. Spoiler alert, all of them are hard and all of them suck in different ways, and all of them are great in different ways.
Yeah, and then it comes back to, we were talking about like asymmetric, like risk and return, and your strategic advantage. And like what's really hard for me might not be so hard for you because you have a different skill set as me. So it's like thinking you need to jump into my business because you see the money that you can make from online, somebody who's lending, for instance, but you have a different strategic advantage, and you have a different skill set. Just because I'm making money and it's the right move for me, there might be a better move for you doing something else. So understanding that and really kind of leaning into your own like kind of expertise and trusting in that, and your goals as well, of understanding like the kind of business. Like I really value high cash flow, and I don't like, knowing what I know now, I regret investing in so many syndications and things, and I can't wait till that money gets back. And it's mostly because you got to wait 3, 5, 7 years for your return. I really value a business that cash flows every single month, investments that are bringing in a good return on value. Some people are like, oh, I'll put $1 million in, and as long as I get $2 million in the next 3 or 4 years, I'm good. I don't really want that. I want to
Yeah.
see the compounding. I want the cash flow of that. So understanding that, I think, is huge as well.
Yeah, kind of like knowing yourself and like knowing like what you're really looking for, and not comparing, goals, because everyone has a different goal for what they want their life to look like as well. It's some people get joy out of working 7 days a week and they're, fully committed to the grind, but then there's others that they want to have this, I call it work life integration, where it's like, I want to be working on the things that I like to work on with the people that I want to work with, in opportunities that I want to work on. And, some weeks I'll work 60, 70, 80 hours because it's like really focused in. Some weeks it's like 30 hours because I have other things that I'm doing with friends or family, and like that's okay. And so I think everyone has to figure out what that looks like for them. And then going to one of the other points that you shared here as well was like the learning, like being like you know, a dedicated learner to figuring out whatever the thing that you're trying to learn is, and then applying. And I think a lot of people, they get stuck in like the learning and analysis paralysis phase, where they're learning and then they're not implementing. I'm very similar to you in that way too, where I'm never going to, like, I just accept I'm not going to be the expert. I'm going to learn as much as I can, but as I'm learning, I'm going to start taking action, and then getting feedback, and then making adjustments. I think if people, it's like more people will spend a whole week trying to plan for something versus just take action. You're going to get feedback from the market to then have to make adjustments anyways. Like I'll of course correct it 100 times in a week before someone takes their first action, because they're trying to create this perfect plan. And in business, there is no perfect plan. Your plan gets screwed up. Like I will tell people this, it's like we're very strategic, and like we'll put together, our goals for the year. We'll do our annual planning. We'll do quarterly planning. Like we have a plan for the year, but then life happens and business happens, and like stuff changes, and you have to pivot and you have to course correct through those things. And I think, not enough people do what you're saying there, which is, yes, learning is super important, but then just applying it and being okay that you're going to screw stuff up. Like
Yeah.
every acquisition I do, we screw stuff up every time. We've been screwing stuff up, but we're learning and we get better every time too. We do something like like on this accounting deal I bought, next week will be officially a month since I've owned it. Every time we buy something, we have like a 30-day review of all of our learnings of stuff we missed in diligence, of the things that we want to do better on the next acquisition, how we would have done our integration better, our integration planning better. It's just like you just review and like you reflect and you learn from it. And then the important part is, we call it internally, we only allow learners to work at our companies. You're either a learner or a non-learner. A non-learner is someone that they make the same mistake over and over again. So those people aren't allowed to stay and work at our companies. Learners make mistakes regularly, but then they don't make the same ones over and over again, because that's not okay.
and I think being a business owner, a huge portion of that, especially even with having a team and me having a small team right now, is like there's some mistakes that like the door's left open. You can kind of rectify. So it's like, we did this wrong. Like I have a template email and my EA, he was supposed to input the exact date and amount in the email. And instead it still said like insert date. Like and he sent that to like a potential investor. Yeah, I'm not happy about that, but it's like we need to highlight that, make sure, that anything highlighted in like, it's like, that sucks, but it's not the end of the world. Now, there's certain things that it's like, all right, if this mistake happens, that can really impact money. And those are the ones that I'm making slower decisions on. So I encourage people, those faster decisions that you wouldn't like, but it's not going to really impact things. Hey, sorry, we forgot to insert the date, like the actual date on this email. Not the end of the world. We can kind of figure that out along the way. But the bigger things, obviously be slower on that. But to just be scared of making those decisions altogether. And it's like, so I'm not going to create a template email, so I don't have to write out this email every single time that I've noticed that I've done 20 times. No, I'm going to put a template, and he did it wrong. So now I need to like correct my template so he knows he has to fill these spots in. And I wouldn't have known that if I didn't just get going. You know what I mean?
Yeah. And that's the most important part. Just getting going and learning, course correcting along the way, and knowing that you're going to continue making mistakes forever. That's, I'm always telling our team that. I'm like, we're going to make mistakes this week, this month, this year, and, let's just learn from them and not make the same ones over and over again.
Yeah. One question I had for you before we hopped off is, my biggest bottleneck is definitely capital raising. So I'm kind of focused on that. But outside of that, I'm really, I feel like I'm probably a ton I can learn from you and your team at Scale with Pros on like growing my team and the operations. But like I've learned a lot along the way. I've built out SOPs, all of that. But when it comes to like figuring out how to navigate like managing a team as it grows and what roles everyone needs to play and making sure the sequencing happens, is there any like good, because all right, if I have a transaction coordinator and then a servicer, like there's going to come a day where I'm not in between that. Like, so it gets funded and like I clear the wire, but then I don't want to have to micromanage. So I'm trying to figure out how to implement the systems that I can trust that it can transfer from one person to another within my company without me having to reinsert myself. Because if I can really focus on like bringing in great borrowers and the marketing side, because I don't really need to spend much marketing money because my brand and name is, and then investor relations and a lot of the admin, like pretty much all the admin can be handled. I kind of see that as a vision that could help things take off. But I'm like, how can I trust? There's pivotal points within that like need to be checked off. Like, so yeah, any advice you would have on that?
Yeah, I visually can see it now in my head as you're talking through it. So like what I would look at doing, and this is like a recommendation I give to everyone, is so what I would do is, have you heard of Lucid Chart?
No.
So a Lucid Chart or Miro, similar tools, we use Lucid Chart to do like process mapping in our company. So what we'll do is I would map two things out. I would have one Lucid Chart, and it's little boxes where you'll like each step of a process. And so I would do one for the front end, like the sales component of the business, and then the fulfillment end. So like the sales component would be like at the beginning of the process map would be like, how does a lead opportunity come into the business? And so it's like lead comes in, what happens next? Goes into email or SMS sequence, goes to, outreach needs to happen. And so it's like, okay, that outreach process needs to happen. So like each of those individual boxes of every single step that's going to happen from lead in the door to this is now a client of ours, that's mapped out. Because then the thing that you can do with that is you have each of those individual boxes, and you could also then assign what role is accountable in the company for each of those specific processes to be done. So then it's super clear of who owns it and at what specific stage, so no batons get dropped. It's like you want to look at it like a relay race. And you have a 4-person relay race, it's like you want to have a clear handoff and clear take of the baton. And so at each of those steps in the process. And so if you map those out and then you use a tool like an Asana, so we use Asana for project management within our companies. There's lots of different project management tools, so whatever one you and your team would like to use. But you can use a tool like that to then mirror your processes in your Lucid chart map. And so then as it's going through each of those stages, whoever's accountable for each step of that process is moving it through the project board. And so you can get a high level view of where all of these are at in the process. And then, so that's on the front end. And then when you have like the fulfillment piece, then you map out the fulfillment. Okay, well, loan has been funded. So that's, that step of the process. So then each of the boxes are going to be, what are all of the things that happen once loan has been funded? Each step of the process till, funds are brought back. And then you can have a process created for each of those individual boxes with who's accountable for it, and with Loom or whatever documents associated, and that becomes your map of here's how we bring in a lead opportunity and fund a deal, and here's how we manage that deal once it's been funded all the way to return of our capital. And so you just have that map, and then you build out an Asana board of each of those steps, and then each person knows where they're supposed to step in, because you just put underneath it. Yeah, you just make it super clear of who owns it at which stage.
I mean, that makes a ton of sense. You probably know because you've done some loans. What about like variable things that come up? Because I'm like, I don't know how to account for that if I'm removing myself. Like, for instance, I had a draw request yesterday, and they tried to slide in like filming video, because it's like they're doing a large value add. I'm like, no, you don't get to get paid for filming a video in the house. That didn't repair the house. So it's like, how do I one day teach my servicer? Like I would have never guessed that would come up. And I literally looking at the scope of work, and it said $1,000 for, video filmer. And I'm like, we're not refunding you or, giving you your draw for $1,000 for that. So I'm afraid to remove myself from that when there's like variable shit that comes up like that, where I'm like, if I'm removed, what happens?
So here's how we handle variable stuff. So over time, your variables will likely end up being somewhere between 5 and 10 of similar types of things. And so if you're at draws, right, and it's getting to draw stage, you can have like a dot or like a Google sheet of something of like, here's the freaking 12 different nuanced weird things that can happen and how to handle each of those nuances. And so every time there's a new nuance, you add that now to that doc, so it's ever growing, so that whoever's handling it, yes, at the beginning, you're going to have to tell them how to handle it every time, but each time it's like that weird nuance, adding it to the list, and so that they can go to that and see how that should be handled in the future. So it's like at the beginning, you're like telling them a lot of times what to do with it, but over time, you're starting to build a bank of types of answers or responses for how to handle that particular situation. So then, 80% of the time they could handle it, and then now there's that 20% of other weird crap that can come up. And so then every time that happens, though, you have them add that, and so it's like less and less over time. And so it can seem
almost like constantly improving your SOPs, but really using like Asana and stuff to help with the granular, because it could get those things start to pop up and it can start to compound on itself. Like
they're like, they want to draw a day early. They're not really done with that stage of the project. What do I do? It's like all of those weird things. And it's like, well, John wants to get paid because it's the holiday and It's just like, how are we going to handle that? And so it's just building those over time. And so it can become overwhelming sometimes to try to solve the entirety of it. So it's just thinking of it more of, if within, the next 6 months, 50% of the time that team member was able to handle it, that's a win. And over a year, they're now handling 75 to 80% of it. That's a win. So it's just seeking incremental progress in those areas to have less and less of it as you're continuing to add on the, whatever canned responses need to be created for those nuanced situations. And so that's kind of how you build it out at each of those, stages of a process, and you just kind of add to those over time.
Add to it over time. Okay.
Mm-hmm.
That was very helpful. I appreciate it.
Yeah. So that's I know we're coming up on time, but I would pair that with, and you can download on our resources. So for everyone else too, like if you go to scalewithpros.com/resources, we have a bunch of templates and stuff. So like you can just get you pair doing that with then doing like regular one-on-ones with your team on a weekly or every other week basis, where you're holding them accountable, coaching, training, guiding, getting on one of the one-on-ones. They're sharing their 3 weird nuances from last week, how now there's a new process for those, so those shouldn't show up again. And then as you build your team that then is managing people, you have them start doing those same things. So you start creating these cadences around meetings. So, they're just more organization of all of the processes. So it's like you create the processes and then you hold the team accountable to those processes, and then they help build them as, nuances come up.
Yeah, that makes a ton of sense. And then the quick last one, I don't have a CFO.
Yeah.
But I have a bookkeeper. And I have KPIs and stuff because I've learned about that. But I don't know. I want to teach my bookkeeper how to create how do you go about identifying the metrics that really matter in your business when you don't have your own CFO? Because essentially, I probably won't have a CFO role for a really long time.
Yeah, fractional would be the most you'd want for a while.
Yeah. So but I'm like, I want key metrics to be able to be tracked, and I'm doing it some. Like I have a KPI sheet of things I like, but it's like, oh, within my business, should I track CAC somehow? Like I know what my marketing budget is because it's so low. It's really just like my CRM and sponsored events I do, but kind of identifying, like looking at my P&L and balance sheet and like, all right, these are the things I should really be tracking. And then like almost creating something to where in the meantime, my bookkeeper, our EA is like plugging in the data from my loan servicing software and my accounting, like my P&Ls and balance sheets to give me reports. Like my problem is I could get to like a $5-10 million gross business and technically maybe not have a CFO because I would hire it. So I'm like, if that's the case, how do I start to track those big metrics? Like, is that something I'm just going to have to learn and then build out, or what would you recommend?
Yeah, 100%. So, outside of the podcast, happy to talk with you on a little bit more of that too. But, like high level, from like big picture, the first thing that I always like to have for any business, like we're doing this for the accounting firm. We're in the second week of like with them on their scorecard, is like looking at just like big picture metrics for the business. And so the frame that I like to look at, just starting with that, and then you'll go into more granular financial data. But we create a high level company scorecard where we're looking at the conveyor belt of the business, which every business I look at as a conveyor belt, where it's like you have marketing leads here that fall onto the conveyor belt, a conversion mechanism, a sales thing happens, and then they go down the conveyor belt, which is the fulfillment. And then I look at like the cogs of the wheels below it. Moving it is like, your financial management, like HR, people stuff. And so I look at, at the top of a scorecard, we want to have like the most important metrics around marketing as far as like leads and stuff like that, then going into sales, then going into fulfillment, and then going into, financial some of the most important financial metrics. And I like to look at like a starting point, shooting for like 3 to 5 key metrics in each of those areas to start with. So, it's like total leads that came in last week from organic and paid. Great. Total calls booked from, those sources that came into our system, total marketing spend, if there was anything spent, what was the result from that? So it's like starting to look at just some of the metrics. And the way I like to look at like the company level scorecard is that should be able to pass a deserted island test is what I, tell people is like, if you were on a deserted island and you couldn't talk to anybody and someone filled out your scorecard for your last week's data, would you be able to know whether the business is directionally going in the right direction, or if it's going in the wrong direction, so that you can just manage, because you want to manage your business by the data and hold your people accountable to doing the processes in the business, but then you can just, make tweaks based off of
Manipulate the data,
decisions
yeah.
from the data. Yeah. So like I would start with like all of the high level data, and I'd be happy to look at what you have on that too. And sometime soon too.
Okay, awesome. Appreciate it, man. This has been great.
Yeah, absolutely. Super fun. So where the heck can people learn more about you, Devon? Where could people connect with you? And then we'll make sure it gets in the show notes.
Yeah, you can find me anywhere at Devon Kennard, pretty much on all social media there. My lending company is weare42solutions.com, and you can find us on Instagram and LinkedIn and all of that there. And yeah, if you're doing business and you're in the real estate space here in Arizona, would love to connect with you.
Awesome. Well, thank you so much for being on. And for everybody listening, we'll see you guys in the next episode.